Hello, welcome back. Here is Ali Talabi, and this is Module 17, the second lesson. As I promised, in this lesson, we'll talk more about signaling, and you will see that in addition to the the financial implication of those payout policies on paper, you have to consider the information content of those events. So we'll talk about signaling, and also we'll talk about the different approaches or theories and dividend policies, and specifically we'll talk about three different theories. And finally, we'll talk about one of the most attractive topics in the world of dividend and capital gains, which is the tax treatment. And what is the implication of for the tax payment when it comes to dividends or capital gains? So as an investor, which one you prefer to have? Would you prefer to have higher dividends or prefer you have the higher capital gains? So we'll talk about that in this lesson. So let's start our second lesson. So remember, when we talk about the dividend, usually companies are paying dividends out of their earnings. So one of the major terms which you need to know, it's called payout ratio. The payout ratio is showing what percentage of earnings is paid out to the shareholders. So usually we are using the DPS over EPS. What's DPS? Dividend per share divided by earnings per share. Or if you go with the total number, we can go with the total dividends divided by the net income. So the ratio are same. Doesn't matter you're using DPS over EPS or total dividends over net income. So why, again, this kind of the ratio, the dividend amount is kind of important to us? Because usually if the company is increasing the payout ratio, if the company is paying the dividend payment, it means that the company is confident regarding the future growth and the future earnings. Which means that that's a very positive signal for the market. And what's the implication for the market? Usually the stock price will go up because you are sending this signal to the market that I'm going to perform much better in the future. Remember, investors, they hate when you cut their dividends. So my advice for the companies, never ever increase your dividends unless you are confident you can keep that in that new level. Because dividends cuts will send a very negative signal to the market, and there is a higher chance that the stock price will go down. So again, do not increase the dividends unless you're confident you can keep it up. So let's talk more from the theoretical perspective. So when we talk about the dividend policies, there are several arguments that dividend policies might be important, and also there are some arguments which saying the dividend policies or dividend payment, it doesn't matter, which means they have no impact on the market value of the company, they have no impact on the stock price. So the first approach, we just call it dividend policy is irrelevant. So it doesn't matter what is your dividend policy, what is your payout ratio, it doesn't impact on the stock price or the market value. The major one, which is kind of we can classify under this category, is called MM theory or Modigliani-Miller. So they argue that under ideal conditions, the value of the firm is affected by dividend policy. Now, maybe you say, Ali, what is the ideal conditions? So they set several assumptions. For example, they say the market is ideal capital market, there is no transaction fees, there is no taxes, there is no cost associated with financial distress. The markets are efficient, assets are correctly priced. So, and there are several other assumptions which they are making. And based on these assumptions, they say, you know what? It doesn't matter the company paying the dividend, doesn't pay the dividend, or what is the payout ratio. So that's kind of irrelevant. So it doesn't matter. The dividend policy doesn't matter. And again, you have to be careful as you're adding more assumptions to your argument. It means you are putting more limitations. So the implication or application of that theory becomes more limited. Maybe you are a big fan of receiving dividends. So because you believe that a bird in the hand is worth two in the bush. For sure you heard about that. What does it mean? It means you prefer to get your cash dividend now instead of getting sometimes in the future, which means that you will get a higher stock price and you will get some capital gain. You're saying, you know what? To me, it's much more important to get my dividend right now because I know what to do with my money. So if you are in this category, your argument is in line with the Gordon's model. What is the Gordon models? If you remember, we talked about this before. The Gordon's model is saying the current value of the stock price is actually based on the present value of all future dividends. So if the company is paying higher dividends, the value of the company, the stock price should be higher as well. So the dividend policy matters because if you're paying higher dividend, it means the market price will be higher, the market value will be higher. Now, the third type of theory, it's called theories which are saying it depends on several factors whether the dividend policy is relevant or not. And mainly, they're talking about the cost of capital and the rate of return of the company. One of the most famous one is called actually Walter's model. So Prof. James Walter, he came with this argument that depending on the relationship between the R, the internal rate of return, and the cost of capital K, the impact of dividend policy on the value of the firm will be different. Now, there are three possible scenarios. If the internal rate of return, which is the rate of return of the investment of the company, is greater than the cost of financing or the cost of capital, so it's better to keep the money in the company. So if you pay dividend, what will happen? Paying dividends will reduce the value of the firm. So don't increase the dividends. Just try to decrease the dividends. Keep the dividend in the firm, keep the money in the firm, and just reinvest on your project. So it's better to go with the decreasing dividend payment. In this case, you can increase the value of the firm. However, if you're not able to make good money, if the rate of return is less than the cost of capital, so it's better to pay the money to your investors. So if you want to increase the value of the firm, if you don't know how to use the money of your investors, why don't you give them the cash to work with that? So it's better just to pay out the money. Don't keep it in the company. Don't keep the money in the company, because if you keep it in the company, what will happen? The value of the firm will go down. And finally, if the cost of capital and internal rate of returns are same, now we can go back to the first theory, Modigliani-Miller, which they argued that dividend policy, payout policy is irrelevant. Now, in this third scenario, if R is same as K, it doesn't matter. You are keeping the money or you are paying out dividends. There is no impact on the value of the firm. Now, let's talk about the tax on dividends capital gains. So for sure, as an investor, it is kind of vital for you to know under which scenario you are paying higher taxes, dividends, if you receive dividends, or you get capital gain. And when I'm saying the capital gain, what does it mean? It means the changes in the stock price. For example, if you paid $100 last year to buy one stock, now it's $120. It means you made $20 on capital gains. But for sure, this is not tax-free, and you have to pay taxes for that. Unless you have a kind of tax-free saving account or any other type of account which is kind of waived from paying taxes, most probably you have to pay some taxes on capital gains. Now, the argument here is which one is better, or which one you pay lower taxes, dividends or capital gain. First of all, remember, when we talk about the capital gain, you don't need to pay any taxes until you sell your stock. For example, you paid $100 last year for this stock. Now it's $120. So what? You are not paying any taxes now, unless you sell your stock now. If, for example, you are not willing to sell now, you don't need to be concerned about the tax implications. So when the profits are realized, that's the time you have to pay taxes on capital gains. And remember, the tax rates are different for sure for capital gains and dividends. If you are in Canada, if you are buying and selling a stock and you realize return here, remember dividends are taxed more heavily than capital gains. So it's better for you just to go with capital gains, don't receive any dividends. So you might choose those companies who are paying less dividends and their payout ratio is much less. However, in the US, it's not that simple. It's a bit more complicated. For capital gains, depending on, we're talking about the short-term holding or long-term holding, the taxes are different. So if, for example, you hold a specific stock for a short period of time, and when I'm saying short, I mean within a year, you have to pay higher taxes, and the taxes will be similar to ordinary income for the year. So you have the tax bracket for the income, same argument for the short-term capital gains. However, for the long-term capital gains, so if you hold a stock over 1 year and you realize some profit, the tax rate will be much less, so it's better for you. Same argument for dividends. We have ordinary and qualified dividends. So depending on the type of dividends, you will pay different tax rates. So ordinary dividends are taxable as income, similar to the argument we had for the short-term capital gains. And qualified dividends receive the lower tax rate, again, similar to the argument we had for the long-term capital gains. Maybe you say, Ali, how you can become qualified? So what is the qualified dividends? To qualify for the qualified dividends, the payment, there's some actually conditions should be fulfilled. For example, the payee or you as an investor must own the stock for long enough time. And when I'm saying long enough time, it's at least for 60 days for common stocks and 90 days for preferred stock. That's one of the major conditions. Another condition is that dividends also must be paid by a corporation in the US or with the certain ties to the US. So these are two major conditions which should be fulfilled to be considered as a qualified investors and qualified dividend, and then you can pay much lower taxes. That's it for today. Thank you very much. Have a wonderful day. I hope you make the right decision when it comes to dividend capital gain. Enjoy the rest of the day. Talk to you soon. And here is Ali Talabi.